Hey, John Walker here with Vision Mortgage Group. I'm here to discuss what seller-funded buydowns are today. And these are a true win-win for sellers and buyers in this volatile real estate market. As interest rates are rising, seller buydowns are making a bigger comeback. And here's what you need to know about them. All right, there are two different types of buydowns, okay? You have your permanent buydown and you have your temporary buydown. Your permanent buydown, we pay for points, and that reduces the interest rate for the entirety of the loan, whether it be a 15-year term, 20-year term, 30-year term, etc. Also, with a permanent rate buydown, that can impact your debt to income ratio. So if we buy that interest rate down, we can reduce that debt to income to help you qualify for more home. In a temporary rate buydown, it reduces your mortgage payment for the first 2 years, or first 2 years, or even up to first 3 years of your mortgage payment, depending on the program that we have in place. And that's based on using a small amount of the contribution each month to subsidize the interest that would be normally paid on that mortgage payment. Here, how does a permanent buydown work? Well, this is how we applied some seller credit in a fictitious scenario, just to give you a broad base of numbers. These are not accurate numbers. Don't hold me to them, and know that 3 points for a 6.25% interest rate is completely inaccurate today, but it gives a great illustration on how effective putting your money toward, or your seller contribution towards points can affect your interest rate. So in this case, we started at a 6.75% rate. I've been doing that a lot lately. 6.75% rate. If you wanted to pay $2,600, it'd be a 6.625. And let's say your friend down the street capitalized on the last in February when the market was relaxed a little bit and the interest rates dropped, and they were at a 6.25%. You're like, yep, I'm gonna spend that $10,000, and I want to have that 6.25% interest rate. I want you to know that yes, the interest rate's important, but there's also what we call return on investment, and how we need to know how long it will take for you to realize that $10,000 back when you purchase your interest rate points down. When you buy those points, we want to make sure that they're paying themselves off in a timely manner, because otherwise you're just you're going to end up refinancing it before you reap the benefit, and it just doesn't make a lot of sense financially. How does the temporary buydown work? Well, this is a little bit more complicated, and this is where the seller credit is put into an escrow account to supplement the borrower's monthly payment for the term of the buydown. So in this case, we're going to illustrate a 2-1 buydown. So the first 2 years of the loan are going to drop an interest rate 1 percentage point of interest per year. So the first year it's 2% lower than the year we start. So in this case, our example interest rate is 4.75%. Our loan amount is $225,000, and our normal fixed principal and interest payment would be $1,173 a month. When a seller credits the buyer with an amount to subsidize that interest rate, this amount is applied to the monthly payment in years 1, 2, or 3 to reduce the borrower's initial payment. This strategy helps a home buyer ease into that house payment, frees up some funds, and for other things that might have generally gone to a house payment. Maybe you needed to use it to offset some additions or new paint or upgrades to the home. So in this case, I did the math, and I used the same scenario that we did earlier with the $350,000 loan, 30-year fixed note. Our APR is 7.23, and I'm sitting at 6.75%. That's our interest rate starting out. That would be considered our par rate. Our monthly payment would be $2,200 or $2,270. Well, our first year, our monthly payment is actually going to be $1,826, saving you $444 a month. Because that first year, and that's a calendar year, so the first 12 months of your mortgage, you're paying an interest rate of 4.75% as the buyer. The borrower or the seller has money in escrow that is subsidizing that interest rate, that $440 each month, to ensure that you get that rate. The second year, your monthly payment would increase. So after 12 months, that 13-month, your monthly payment increases because your interest rate goes up to a 5.75%. And with that, your monthly payment is now $2,042. And now coming out of that escrow account every single month is $228. Okay, you tracking? I know it can seem a little weird, but you can back this thing up and watch it a couple times. And last year, so the third year, you're back at 6.75%. Monthly payment's $2,270. Now, hopefully, we can refinance you at that point, get you into that 4.75%, and you're rocking and rolling, and you don't have to think about it. Okay, so here's some of the benefits that I've seen for both sellers and buyers. I broke them down into three different bullet points each, just to try to help make some clarity of this. So as a listing agent or a seller, the benefits that I would present would be, one, the seller credits help a home sell faster in this market. We're seeing homes stay on the market 65 to 100, even 200 days, depending on where you're at. And that is because it's at a price point in which affordability comes into a bit of a struggle. So when you come in with these seller credits, you reduce your overall negotiation and you increase the opportunity for the buyer to be able to benefit and afford that monthly payment to move in. Second, price reductions cost more than seller credits. Let me say that again. Price reductions cost more than seller credits. And I'll be able to show you that in the next slide. And the last thing, if you put on a listing, your listing as a listing agent or as the seller, hey, we're going to give $10,000 worth of lender credits, or excuse me, back up, $10,000 worth of seller credits. It really is an innovative, goodwill, hand olive branch reaching out to start the negotiations. Because what that's doing is that's saying, hey, buyer, you know what? We're at this price point, we'll call it $450,000, and we're already willing to give you $10,000 worth of closing costs because we want to help you get into this home and we want to sell our home fast. It shows some urgency and really just some goodwill. On the buy side, buyer benefits, there's a ton of buyer benefits, but some of the biggest ones are it allows a buyer to ease into home ownership by paying below actual fixed rate payments for the first couple of years, like we saw in the last slide. And it does not increase the loan, or doesn't increase the loan amount. These aren't interest-only payments where things are rolled back on the back end, folks. These are fixed rate payments, and they're just subsidized on the front end. And lastly, they're a safe way to take advantage of a lower payment in this volatile rate environment. As we all know, we've been watching media, we've watched everything. Things are moving up and down pretty rapidly. This is a great way to just sort of insulate that and secure a lower interest rate for a little while until the market can catch its breath and we really figure out where we're going to land. And even hopefully, possibly refinance you within 12 months so then you can maintain that, let's say, 4.75% interest rate. Here's an example of the price of a price reduction versus a seller funded buy down. And let me show you this scenario. So let's say buyer says, hey, seller, I want to buy your house that's listed at $275,000, but I want to actually, I'm going to offer $261,250 for the home. And buyer's like, or the seller's like, wow, I didn't really want to take that big of a cut. Seller counters, you know what? I'll tell you what I'll do, buyer, is I will sell the home for $270,000, but I will give you $4,700 a month, or excuse me, $4,700 of seller credit to allow you to use that towards closing costs and prepaids. So if that is a seller rate buy down or just overall closing costs and incidentals. By doing this, that seller nets an additional $4,050 more than if the buyer or if the seller would have taken the price reduction. And I can tell you that the borrower is probably going to end up with a better interest rate by taking the seller credit. Okay, what types of loans allow seller-funded buydowns? The top four are conventional Fannie Mae and Freddie Mac loans, our FHA loans, our VA loans, and our USDA loans. For our conventional loans, it really is going to be dependent on the seller can only contribute up to the maximum amount allowed based on the down payment. So if it's within 10%, the seller can only contribute up to 3% of the overall purchase price of the home. And then we can go to 6% and 9%. In the FHA world, FHA, you can go up to 6% of the purchase price of the home. VA is 4%. Guys, these are out there. If you need more information about this, please give me a call. Put some comments in the notes below. Shoot me an email. Shoot my business or contact information at the end of this, so then you guys can reach out to me. Okay, which program is better? Well, it really just depends. It's a case-by-case scenario. And that's why you have me. I'm here to help guide you and align with you and provide you all the information that is out there in this wide world of mortgage opportunities. You need a lender that's going to be flexible, creative, and truly a coach. And that's where I position myself, and I take that very seriously. I'm here to show you all the numbers and give you all the scenarios, so together with myself, a great realtor partner, we can align and help you build the best strategy when you're making your offer so you're successful. Secondly, listing agents and sellers. I can walk you through scenarios that are very specific to your property to help you see the advantages of either rate reduction or seller contributions or a price reduction. Buyers, you need to consider all your options out there. And one of the best ways to do that is really do a good job of interviewing your lenders and finding out if they're versed and they can talk about these scenarios, like the 2-1 buy down or a temporary buy down versus a permanent buy down. These are all valuable things that need to be discussed, because this is one of the biggest transactions you are going to do in your lifetime. And without some support, you're going to feel like you're in the wind. So if you want a coach on your side, if you want somebody to be there in your corner and really fight for you and be able to coach you through these things, hit me up. Lastly, folks, again, I want to thank you for your time. I know that this is a little bit thick as far as material, but overall, this is a real broad stroke. Watch it as many times as you want, or if you really just want to discuss your own situation, reach out to me at Vision Mortgage. Again, my name's John Walker. My phone number's there, my email's there. Just reach out to me and I'd be happy to jump on a call or a Zoom and we can walk through this. Together, we can make your homeownership dreams come true. We just need to put the pieces together. So thank you and have a great